Ben Lichtenstein. I am JB McKenzie, Managing Director of Futures and Forex here at Charles Schwab, and I am your guest host for the week. Let's talk about what's going on in the markets, and to do that, let's bring in our next guest, Scott Bauer, CEO of Prosper Trading Academy, to the show. Scott, always great to have you here. I've got a question starting
here with you, JB.
Well, it's been too long, but that's all right. We'll talk about that later. But I want to start off because I thought yesterday's move was just really an amazing move. It was on there, a big shift. I mean, down almost 500 points to a rally to the upside. Part of me looks at this as sort of that little relief short-term rally, but you're a smarter man than I am. I'm curious, what is your take of what you saw from the market yesterday?
Well, I would beg to differ on that one, but I agree with you. I think he had a little bit of dip buying yesterday, but I'm not buying into it, JB. It's not the sort of thing where I think you can look at it and say, we've hit the bottom by any stretch of the imagination. It didn't seem like any sort of capitulation, if you will. I mean, yeah, VIX was up 30, I think maybe even 31. Didn't look like a lot of panic yesterday, though. So, it was nice to see that there are some buyers out there maybe looking for, some of these stocks that have just gotten absolutely pummeled, especially some of the big high growth tech stocks, maybe going into earnings. But I'd still be pretty cautious overall.
Now, as you're looking here at the market, and again, I thought it was an interesting move. All attention was on the 10-year and the 10-year pulling back. It was 3 days ago, we were basically at our, the high, and we came back off. I guess the question I have is, do you feel as though there's enough in the market to say, hey, that the COVID concerns out of China, maybe we don't need to tap the brakes, or I should say slam the brakes as hard, a tap will work? Because we were just talking 50 basis points, just last week, but now all of a sudden it feels as like we've taken a breath. I guess I haven't seen any narrative. It just feels like there was an odd reaction in the market, especially when it comes to that 10-year.
No doubt about it. And the news out of China was huge. And if you look at some of the big retailers, like I followed Costco really closely yesterday. So some of these stocks that are so dependent upon supply chain, especially the retailers, I think there was maybe a bit of an overreaction early on the news coming out of Shanghai. And we don't know what's going to happen there. But I do think that, in terms of the lockdown, what we saw yesterday, that drastic move in oil as well, I think that was overdone. I got long oil futures yesterday. I don't think that the lockdown concerns, though they are very, very considerable, I don't think that's a reason to say, okay, this is what the next 2-4 weeks of trade in the market are going to be. I think when we see news like this, JB, and you know this, there's always kind of some shock value to it, maybe a little bit of overreaction. And again, I'm not saying that this is not a very important thing to be concerned about, but I looked at that yesterday as maybe an opportunity to dip your toes in a little, couple different areas. But I don't think we're finished just yet. So you know what? Over the next 3 days with the big tech earnings, that could really be the telltale for what this market does over the next quarter.
No, and I think it's a great point there. A lot of the eyeballs have been on, let's get ready for these big mega tech stocks coming through with their earnings. One last thing on the interest rates before I swing into a couple other markets here. We keep talking about yield curve inversion, right? And it doesn't matter on which duration of the yield curve you talk about, but it was interesting. The 530 was the most recent to invert yesterday. And obviously now things have, I read this incredible question last night, but now all of a sudden it goes the other direction here on me, Scott. Yep. But I guess my question is, we usually say that as an indication to a possible recession or potential recession, but we seem to have this happening on a variety of different short-term or different parts of the duration of the curve for short periods of time. Does that worry you? And again, I know you know the treasury markets pretty well here. Does that concern you as much, or are you really kind of focused in on saying, hey, look, I'm taking my quarterly views. I want to talk about earnings now. I want to look at some economic data. I'll leave the interest rates where they are because that's sort of a different area of focus for me at this point with so many earnings on the table.
It is a different area, JB. And when you talk about the inversion and it being a sign of what's going to happen to the economy, you have to remember that's typically 6, 12, maybe even 18 months down the road. So if I have my trader hat on, yes, you need to be cognizant of what's going on with rates, but I am hyper focused, obviously, on the more micro of what is happening day to day right now. Earnings, what is coming out of China is certainly affecting the market. Obviously, what's happening in Ukraine is affecting the market. But I think you need to be focused on the earnings reports right now as a trader. If you're looking into just individual stocks, maybe the Qs or the S&Ps, I think you have to focus on that. A longer term view, though, you definitely have to be aware of what is going on with an inversion and the possibility of a recession again, but that's down the road. That's 12, 18 months down the road.
No, totally fair, and I think that's a great point here. I'm going to go to a product that has to be on the top of everyone's mind, and I feel like is crushing it right now, and that's the dollar. As you look at this dollar on its rally, I mean, 14 of the last 17 sessions have been to the upside. Despite a little pullback, we're really pushing forward. I guess as you look at the dollar here, we've always said strong dollar actually hurts a lot of these multinationals, especially when we start talking about some of those earnings coming up here. Are you worried at all about the greenback holding above this 101, almost to the 102 level, or do you still see some opportunity for it to either stabilize or move higher?
Well, it has been an incredible move, and I think we're going to get a lot of narrative from a lot of these multinationals over the next few weeks with earnings about how not only is what's going on in the macro space in Russia, Ukraine affecting their potential guidance, but how is the dollar affecting their guidance as well? And we know, like you said, that tends to hurt bottom line for a lot of these multinationals. Now, the dollar is, from an RSI standpoint, just so overbought right now. So I would not be surprised if we see a little bit of a pullback, JB, but I'll tell you what, the momentum, and it's hard to not follow the momentum here. The momentum is really, really strong to the upside. Just, again, I would now play the range of the dollar where we were, 95 to 97 or so for so long as a range. I think our new range, I think, maybe par and a half, so 100 and a half, maybe to 102 is now the range, 102 and a half for the short time here. But it is unbelievable, the strength, the velocity that we have seen in the move in the dollar.
Yeah, I mean, just the month of April has been, it's the employee of the month when you look at what it's done here. It's crazy here.
Yes.
Before I let you go, I appreciate you coming on, but before I let you go, I got a question for you. You got durable goods coming out later today. Yep. You got housing data coming out. You got consumer confidence. You got a lot of data that's coming out that maybe isn't tier one type of data. Any of this stuff on your radar to watch it move the market, or are you already waiting for getting ready for that after the market close to hear from Microsoft and Alphabet?
No, those are important. I think when you look together, combined, those reports that are not those, front and center reports, they are important because they are telling us a little bit more about what to project. They are leading indicators, if you will. So durable goods this morning, for people that don't know what the durable goods orders really mean, and they just see a number that either beat or missed, they measure the change in total value of new orders for long-lasting goods. Long-lasting means, I think 3 years or so, excluding transportation. Well, that gives us a pretty good indication then of what's going on the manufacturing side, which then flows down what is going on with the consumer. I am so surprised, JB, I don't know, you probably are as well, that we have not seen a pullback really of any sort of measured amount yet from the consumer. So I think this is a big number to watch. And I think you have to look at some of these other tier 2, tier 3 numbers you're talking about and maybe look at it as a whole, especially in the housing market. What's going to happen with housing starts here? We all know that it's still red hot. Is it going to start to calm down at all?
Well, Scott, appreciate you coming on again today, sharing some great knowledge about what's going on in Treasuries, dollar, and those numbers coming up later today. As always, great to see you. Looking forward to seeing you in person here very soon. Thanks for coming on the show.
Thanks.
Everyone, that's Scott Bauer, CEO of Prosper Trading Academy. Coming up next, Rick